I have an uncle who invested in HDFC Bank in 2004. That's nearly 20 years ago. At that time, in adjusted terms, the stock traded at about 35 rupees. Now, over the 2 decades, HDFC Bank has given dividend of about 203 rupees per share. This means my uncle not only recouped his initial investment, but HDFC has also returned about 5 times his invested capital, and it's likely to keep generating returns in the future as well. Now, he shared with me that these dividends have become a good source of passive income for him. In fact, he plans to leave this stock to his grandchildren as a legacy. With the stock price now around 1500 rupees, his initial investment has grown roughly 43 times. Now, since he has already recovered his investment through dividends alone, any future returns and dividends are essentially free money for him. Now, he couldn't be happier, and you too can experience such growth by picking good stocks that keep paying dividends as well. Hello and welcome to ET Money's YouTube channel. Today, we are going to talk about dividend investing and how you can pick good dividend stocks. Now, dividends can be a source of passive income too, so we will talk about that aspect as well. But let's begin with understanding 2 crucial dividend related metrics that you should be aware as a dividend investor. After that, we will talk about how you can pick promising dividend stocks. So do watch this video up to the end. Dividend yield is frequently used to quantify dividends. It is calculated by dividing the dividend amount by the stock price. So, for instance, if the stock price is 100 rupees and the dividend amount is 2 rupees per share, the dividend yield is 2%. In other words, for every 100 rupees invested in it, the stock has given a return of 2% via dividends in 1 year. Now, since dividend yield is calculated using the stock price, it will change as the stock price changes. And because dividend yield is inversely proportional to the stock price, it increases with the fall of the stock price. For instance, if the stock price falls from 100 to 80 rupees and the dividend per share remains at 2, the dividend yield will increase to 2.5% from 2%. But this doesn't mean the stock has become more attractive now. On the contrary, the 20% fall in the price needs to be investigated, as it may indicate something bad that may dent the company's profitability and future dividends. So always investigate a sudden rise in dividend yield and ask if it could be due to a fall in the stock price. Now, many investors think that dividend yield tells us what dividends a stock will pay in the future. That's not so. The dividend yield is based on past dividends. Whether the company will pay similar, better, or worse dividends in the future will depend on the business's profitability and management's decision. But still, dividend yield is a convenient way to compare dividends across stocks. For example, HDFC Bank's dividend yield as of 29th May is 1.27%. Its peer, ICICI Bank, has a dividend yield of 0.89%. So, as of now, HDFC Bank is paying a higher dividend than ICICI Bank in terms of their respective stock prices. So, when you start investing for dividends, the simplest thing you can do is pick companies with a high dividend yield. For instance, in the BSE 500, the top 5 companies by dividend yield are on your screen. As of 29th May, IDFC has the highest dividend yield of 10.4% within the BSE 500 companies. Next comes Indian Oil or IOC, which has a dividend yield of over 7%, and then BPCL with a yield of almost 7%. Now, these are pretty attractive numbers, and anyone would like to have such stocks in the portfolio. But chasing dividend yield alone can be a mistake. Let's see why. Now let's consider IDFC, which has a dividend yield of 10.4% in FY23. In rupee terms, IDFC paid a dividend of 12 rupees per share. Now, we found that in FY23, IDFC reported profits of 974 crores resulting from associate companies. The profit from its own operations stood at just 90 crores. Apart from this, IDFC also reported profit from discontinued operations at 3,600 crore. Now, all of this helped it report a total profit of 4,244 crores for FY23. So the reason for IDFC's bumper profits was not related to business performance, but to extraordinary items. These extraordinary items are usually a one-off and don't repeat. Now, it's also likely that the higher dividend payout in FY23 was also due to these one-off gains. So such dividend payouts also won't likely repeat. Indeed, if one sees IDFC's dividend history, it's nothing to be proud of. IDFC didn't pay any dividend in FY22 and FY21. In FY20, the dividend was 3.15 rupees per share. And again in FY19, there was no dividend. So out of the last 5 financial years, it didn't pay any dividends in 3. Moreover, it reported losses in FY19, FY20 and FY21. A company in loss often doesn't or can't pay dividends. So all in all, IDFC's super high dividend can be quite deceptive. It doesn't indicate a superior dividend paying capability. So all in all, it is not advisable to take investment decisions just on the basis of dividend yield. You should always look beyond dividend yield. Okay, let's explore another aspect of the dividend yield. Dividend yield should always be seen in conjunction with the stock price movement. Let me explain. The second company in the list of top 10 dividend payers in the BSE 500 is Indian Oil Corporation or IOC. It has a dividend yield of over 7%. Now let's take a look at IOC's dividend history. Of course, the first thing that we notice is that dividends have fluctuated, and that's because of the cyclical nature of IOC's business. Oil marketing companies are vulnerable to rises in oil prices as this squeezes their gross refining margins. Being a PSU, IOC also finds it hard to pass on the higher prices to consumers given that oil prices are a political issue. But that's one aspect. I'm more concerned about the stock price movement here. Over the last 5 years, as of 29th May, the IOC stock has appreciated by about 9% per annum. Not bad, you may say. Along with the dividends, your total returns would still be in double digits. But if you increase the horizon to 7 years, the returns are 2.18% per annum. In other words, the IOC stock is still around the same levels it was 7 years ago. And much of the returns have come in the last 1 year only as the Indian markets have raced. Over the last 1 year, IOC's stock price has gone up by about 83%. So the idea is simple. While you should aim at dividends, it's important that you don't lose money via the stock price. If that happens, your dividends are nullified. And because the stock price movements are rather quick, they can also result in a net loss. Remember my uncle's experience? The HDFC Bank stock he owns has multiplied his capital by 43 times apart from giving dividends. That's the kind of experience a dividend investor should aim for. So these were some important things related to dividend yield. Let's now take a look at the other prominent dividend metric, which is the dividend payout ratio. Dividend payout ratio is the share of its profit that a company distributes as dividends. For instance, if a company's profit during the year is 1000 crore and it distributes 100 crores as dividends, the dividend payout ratio is 10%. Now, unlike the dividend yield, the dividend payout ratio remains fairly constant as it's based on non-market linked metrics. Both dividend and net profit are business metrics, and hence the dividend payout ratio will change only when the next profit or dividend figure is announced. Now on your screen are the 10 largest listed companies along with their dividend payout ratios and dividend yields. There are some interesting takeaways here. Reliance, India's largest listed company, distributed less than 10% of its profits as dividend. At 0.31%, its dividend yield is also quite low. On the other end of the spectrum is Hindustan Unilever, which distributed 96% of its profits. In terms of dividend yield, it may look quite a middling company, but the dividend payout ratio makes it a star. ITC is high on both yield and payout. And then there is Bharti Airtel, which has a dividend yield of just 0.29%, but a dividend payout ratio of over 60%. But one obvious question here, isn't a very high payout ratio bad? After all, it indicates that a company is paying out much of its profits through dividends and little profits are being put back into the business. And this can compromise the stability of the business itself. That's a valid point, and indeed, large payout ratios can be a problem. However, it also depends on the nature of the business itself. For instance, Hindustan Unilever is a stable FMCG company that has already reached a large scale. Now, when such companies pay out a high share of their profits, that may not be a bad thing. On the other hand, given the capital-hungry nature of Bharti Airtel's business, a payout ratio about 62% may be on the higher side. Coupled with a high debt-to-equity ratio of about 2, giving out high dividends can actually push Bharti Airtel further into debt. On the other hand, ITC and Hindustan Unilever are both debt-free. Now, there are also companies that have payout ratios of more than 100%. That means these companies have paid out more dividends than their profits. On your screen are 10 largest companies whose dividend payout ratio is more than 100%. Vedanta is a case in point. It is known for its high dividends. Let's take a look at its dividend payouts over the last 5 years. Vedanta paid a massive 101.5 rupees per share as dividend for FY23. In FY22, the amount was 45 rupees. Now, one source of the high payout could be the dividend that the company receives from its subsidiary Hindustan Zinc. Hindustan Zinc is Vedanta's crown jewel and has generated large profits. Its FY23 net profit stood at 10,511 crores. But if we see Vedanta's debt to equity ratio, it has increased to 2.04 in FY23 from 0.98 in FY22. Even Hindustan Zinc's debt to equity ratio has climbed from 0.09 in FY22 to 0.94 in FY23. So has the debt increased? Well, yes, but shareholder funds have also fallen for both the companies. There is more. Vedanta has pledged its entire stake in Hindustan Zinc, and the promoter's stake in Vedanta is all pledged too. Now, if you aren't aware of pledging, it means mortgaging shares to raise money. So while on one hand Vedanta is paying high dividends, on the other hand its capital structure seems to be weakening. So could it actually be paying shareholders funds in dividends and then compensating for the deficit by raising more debt? And because a large part of this dividend would go to the promoter, could this be a corporate governance issue? Promoters have even pledged their stake, and that's a sign of worry too. Well, I'm sure there must be counter viewpoint for this, but I, for one, would be cautious of Vedanta's high dividend. Do let me know in the comment section what you think about this. The point that I'm trying to make here is that if the payout ratio is ultra high, try to find out why it's so. A consistently very high payout ratio is not just unsustainable, but it could also indicate something very wrong with the company. Also, if the company's payout ratio is too low, that's probably not a very good dividend stock. So as a dividend investor, one can avoid such stocks too. Okay, let's now use the understanding we have developed so far to see some good dividend stocks. Okay, so what you should see in a stock before you decide to buy it for its dividends. Let me suggest a framework based on what we learned in this video. I will also mention some stocks based on this framework. But an important thing before I do so, neither the framework nor the stocks are our recommendations. The objective is to just illustrate how you can pick dividend stocks and what metrics you should check. If you are interested in any of the stocks, or if you decide to use the framework itself, please exercise your own due diligence and do your own research. Okay, so here is the framework. First, the company should be profitable and the profit should have risen over time. This is important as rising profits would translate into higher dividends over time. For profits to rise sustainably, they should be backed by revenue growth. So revenue should have also risen over time. Let's consider the 5-year revenue and profit growth to be more than 8% and 12% respectively. Second, the dividend payout ratio should be high enough but not too high. It shouldn't be too low either. So let's take it should be more than 25% but less than 100%. You can also consider the dividend yield to be a certain number so that you have some visibility on the size of dividend too. Let's take the dividend yield to be at least 1%. But if the size of the dividend isn't a big concern for you and you are happy with just the payout ratio, you can remove this criteria. Third, the company shouldn't have high debt on its books. This is important so that interest outgo doesn't eat up the distributable surplus. Let's consider the debt to equity ratio of less than 1%. Now do note this metric will knock out most finance companies as their debt to equity ratios tend to be high given that the nature of their business. So debt to equity is an irrelevant metric for finance companies. So if you want to also select finance stocks, don't use this metric, but then do check the debt levels in non-finance stocks individually. Fourth, the stock price should have also risen over time, say by 12% on average. This will ensure that you aren't losing money via the stock price while you are making money through dividends. Fifth, to ensure good quality, the average return on equity or ROE should be 15% or higher. Sixth, to remove very small companies, let's consider only those companies that have market cap of over 1000 crore. Now when we applied these criteria, we got 25 names. You can download this list from the link in the description and start researching these stocks. Avoid the temptation to invest in them right away. Now, when you do your research, do check a few things. First, how consistently have the revenues and profits increased? Have they increased more or less sequentially, or has the growth been erratic? You would want revenues and profit to increase in an even manner so that dividend payouts are also uniform. Second, check the historical dividends. Has the company paid dividends regularly, or has it paid dividends on and off? Also, try to assess the dividend payout ratio. Has it remained uniform or has it fluctuated? You would want the company to pay dividends regularly and more or less maintain or increase its dividend payout ratio over time. Third, try to assess valuation using a relevant metric like price to earnings ratio. This is important because if you buy an overvalued stock, any slight negative development can result in a steep correction. As we saw, if you lose money through stock price correction, that can nullify your gains from dividends and even result in a net loss. Now, what about deriving passive income from this portfolio? Now, this median dividend yield of this portfolio of 25 stocks is 1.4%. This means that if you invest 10 lakh rupees in this portfolio, you would likely get dividends of about 14,000 rupees in the first year. Now, I said a likely scenario as future dividends would depend on the company's profit and the management's decision. But 14,000? That's not too much, right? Yes, but this is what you should expect when you think of deriving income from a stocks portfolio. Around 1% yield is good enough at the portfolio level. And don't forget that stock dividends are taxable too at your slab rate. To get a higher payout, of course, you can increase your investment. For instance, a 1 crore invested in these companies would likely generate about 1.4 lakh rupees in the first year. But the real magic happens when you stay invested in these companies for the long term. As their profits grow, so will their dividends, and your dividend amounts will become better with time. This is exactly what happened with my uncle too. So to derive passive income from stocks through dividends, you should pick good dividend stocks and hold them for a long time. Of course, do check the progress of the companies from time to time. Replace the less deserving ones with the better ones. Now, there are many websites that provide financial information on companies. And with this, it's a wrap on this video. I hope you found this video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.